Okay, let's dive into this. Have you ever looked at the stock market and just felt like you were staring at this vast, totally unpredictable ocean? Yeah, you're definitely not alone. Think of it like this. When you invest in a company, you're essentially buying a ship to sail those waters. And the size of your ship? Well, that literally dictates everything, from how you handle smooth, sunny sailing to how you survive the most severe economic storms. So today, in this explainer, we're navigating the concept of market capitalization, and we're going to learn exactly how company size impacts your investment journey.
So take a second and really think about it. What kind of ship are you currently sailing on the ocean of investing? If you're new to stock investing, I know the financial jargon can feel like a totally foreign language. But hey, you don't need a finance degree to figure this out. We're going to decode all that complexity right now into a simple, relatable maritime guide. We'll explore how the size of the companies you invest in completely determines whether you're set up for a smooth ride, a really fast race, or, well, a terrifying shipwreck.
So, the crucial point is that the secret to understanding your ship lies in one simple concept: market capitalization. You'll often hear it just called market cap, and it's simply the total value of all a company's shares combined. Basically, think of it as the price tag of the entire company. It's just a single mathematical calculation, right? But it acts as the exact size of your ship on the market ocean. This one determining factor completely sets a stock's risk profile, its ceiling for growth potential, its day-to-day stability, and, maybe most importantly, how it behaves when the economic weather inevitably changes.
Let's start by looking at the absolute biggest vessels out there on the water: large cap stocks. These are the dreadnoughts, the massive ocean liners of the market. We're talking about established corporate giants valued at over $10 billion. You know them. These are the household names you interact with every single day. They come with proven track records, dominant market positions, and just vast financial resources. Actually, these massive ships form the very backbone of major financial indices like the S&P 500.
When we look at this large-cap fleet, the primary focus is absolutely on stability and consistency. Often called blue chips, these stocks offer a really nice safe harbor when the market gets turbulent. And because of their massive size and high trading volume, they offer very high liquidity. For a new investor, that simply means you can buy or sell your shares easily and instantly, without accidentally moving the stock price yourself. Plus, a lot of these companies pay out regular dividends. It's effectively giving you a steady stream of cash income just for owning a piece of the ship. But, there's always a catch, because these ocean liners are already so huge, they're incredibly slow to turn. That means they generally have lower growth potential and can actually underperform smaller stocks during strong aggressive bull markets.
Now, if an ocean liner feels a bit too slow and steady for your personal financial goals, we step down a size category to mid-cap stocks. Think of these as the versatile yachts of the ocean. These are companies valued anywhere between $2 billion and $10 billion. They've already successfully navigated that incredibly risky startup phase, which means they have established products, they have real revenue, but they aren't quite massive dreadnoughts yet. And that means they still have plenty of open water ahead of them to capture new market share.
The mid-cap fleet operates in what a lot of financial experts consider the absolute sweet spot of investing. These are your growth engines. They offer this beautifully balanced risk and reward scenario. You get higher growth potential than the large caps, but with significantly less of that wild, stomach-churning volatility you see with the smallest ships on the market. For many folks building a portfolio, it's really the best of both worlds, getting in on the potential to become tomorrow's giants. But keep in mind, they do carry moderate economic risk. They're just a bit more sensitive to a prolonged economic storm than those massive ocean liners with their bottomless cash reserves.
And finally, we reach the small cap stocks. These are valued between $250 million and $2 billion. These are the nimble speedboats of the market. They're ambitious, fast-moving companies that often operate in newer, totally untested, or very specific niche industries. This right here is your opportunity zone. It's the exact waters you fish in if you want to discover tomorrow's massive industry leaders way before the rest of the world catches on.
Now, what's really interesting about this slide is the historical performance. Research shows that over the very long term, we're talking 25+ years, small caps have actually outperformed large caps. Because they're often completely ignored by big Wall Street analysts, you can sometimes uncover some amazing hidden gems. But listen, you are absolutely trading stability for extreme potential here. Small caps come with high risk, massive price volatility, and low liquidity, meaning if you panic and need to sell quickly, you might take a pretty big loss. Oh, and you can practically forget about regular dividends. These speedboats reinvest almost every single penny of profit right back into fueling their aggressive growth.
So this brings us to a really critical scenario that every new investor absolutely must prepare for. What happens when an economic storm hits? Just imagine a severe financial shock, like a deep recession, rolling right across our ocean of investing. The skies get dark, the waters get incredibly choppy. It's vital to understand exactly how the size of your ship dictates your likelihood of survival when the weather turns ugly.
During a recession, the contrast between large caps and small caps is just stark, and it's incredibly important to grasp. Large caps generally weather these economic downturns pretty safely. Why? Because they have ample resources. They've got vast financial reserves, established credit lines, and steady global revenue streams to keep the engines running even when consumers stop spending as much. But our small cap speedboats? Wow, they struggle the absolute most. Their stock prices experience wild, violent swings downwards. Their extreme vulnerability really lies in their funding. When the economy tightens, a small company's access to vital capital often completely dries up. Banks stop lending, investors pull back, and the speedboats essentially just run out of fuel right in the middle of a hurricane.
And this brilliantly illustrates the entire fleet side by side. A very clear pattern emerges here. Notice how perfectly everything correlates. As ship size decreases, going from large cap to mid cap down to small cap, your growth potential scales up dramatically. But in exact tandem, your risk level scales up from low to high, and your liquidity drops. It's literally the ultimate calculated trade-off you make when choosing your investment vessels. You simply cannot get that high growth potential without taking on higher risk and lower liquidity. It's a package deal.
So how do we put this all together to build a truly smart strategy? Well, you might think buying a standard total stock market index fund is the ultimate answer to diversification, but those funds are actually heavily biased toward the large caps. That means you're mostly just buying ocean liners, and you're missing out on the growth of the yachts and the speedboats. Interestingly enough, looking at data over a 25-year period reveals something super fascinating. A strategy that equally weights investments across all three sizes actually produced better overall returns and lower overall risk than a standard total market fund. Balance really is the ultimate key here.
Let's move to and see how this builds your very own diversified fleet. If you're a beginner with a long time horizon, say 10 plus years until you need the money, this is your blueprint for success. Step 1, you anchor your portfolio with large caps to ensure bedrock stability and steady dividend income. Step 2, you build a balanced core using mid-caps. This injects solid growth into your portfolio without subjecting yourself to wild daily volatility. And Step 3, you deliberately allocate a meaningful portion to small caps to capture that aggressive, long-term outperformance. Instead of trying to guess which single type of ship is best, you are commanding a fully diversified fleet scientifically designed to win the long-term race.
Which brings us to one final, really provocative question for you to ponder today. Is your portfolio ready for the next storm, or are you sailing entirely in speedboats? Take a close look at your own allocations. Really check what size ships you actually own right now in your retirement or brokerage accounts. Make sure you aren't leaving yourself overly exposed to the next big wave without an anchor, and start building a smarter, well-balanced fleet today. Thanks for joining me on this explainer, and happy sailing.